Hey everyone, welcome back to the channel. My name is Jack, and this marks another episode of my M1 Finance portfolio series where I'm trying to build a $100,000 portfolio on this platform, M1 Finance. I update it every 15th of the month, and I actually have another M1 Finance portfolio series that I started last month that takes place on the 28th of every month, and that's looking at the magic formula investing strategy, which is a very specific value investing strategy, whereas this broader portfolio that I have encompasses my own personal strategy, not so much just blatantly copying another strategy. Granted, when it comes to investing, there are often a lot of great ideas to be found just by copying other great investors if you can find them and you follow them closely enough, since in the US especially, you have lots of disclosures that need to be made on your holdings if you hold US stocks after a certain threshold at least. Certainly funds have to do this, so you get some really good investment ideas that way, and as Monish Pabrai likes to say, shamelessly cloning is not necessarily a bad thing and often is a very lucrative thing to do. Of course, you should always do your own research and make sure it fits your risk profile, because none of my videos are financial advice and you should always do your own research. But back to the series, we're a little bit over a year into this. I started investing into this portfolio and really just more heavily into the stock market in February of 2020, which arguably was the worst time ever to invest ever. So because shortly thereafter we had the huge crash in March, obviously things recovered swiftly thanks to lots of government propping up of the markets and lots of new money. Some of it is still, all of it is still swimming around the system right now, and we've seen stocks rise very quickly. I certainly benefit from that, but it seems like we're sort of starting to lose a little bit of this steam, and it's really hard to determine what's real anymore, seeing as though there's so much new money in the system. I don't know what amount of these gains is nominal as opposed to real. All I'm trying to do when I'm investing in stocks is to try and identify companies that are solid, have good potential avenues for growth, or are otherwise very undervalued, to where when I'm buying the stock, I feel like I'm getting a discount on it, to where I'm buying it below what it's actually worth. It's the same sort of approach that I would take with real estate. I'm a real estate investor at heart. In fact, I bought my first one last year. I covered that on the channel as well. So if you like real estate investing, definitely check out the channel and subscribe if you haven't already. But the point is, I'm trying to find something that is below market value. The same sort of concept applies to stocks. That's this whole world of value investing. It really fits the sort of thinking of a real estate investor. I like it a lot because of that. It makes fundamental sense. And it makes sense in the long term, at least from what I've seen with the data. Stocks follow earnings over the long term. In the short term, they do all sorts of ridiculous things. You see the huge run-ups in GameStop, for example. In hindsight, we can explain what happened. You had the short squeeze, tons of short interest behind it, and some people thought that might have been coming, but there was no way to truly time it in the short term. You never really know what's going to trigger what. All sorts of different things could happen. In this case, it seemed like it was a band of Redditors got behind it. They could have picked any other stock, and maybe some weird thing would have happened there too. And it's not saying that something like that will never happen again. What I'm saying is it's very hard to time these sorts of things in the short run. And then, of course, a lot of people will get into the game late in the short run and drive a stock up even higher when it's already expensive. And then when there's the first sign of trouble, you get a bunch of people bailing out, and then it swings too hard to the downturn, and now it's undervalued. So you get this constant game of back and forth, and it's a very strange sort of thing that happens in the stock market. But you could say the same sort of thing happens in real estate. When distressed sellers want to sell a property just because they have some sort of issue, you could get it below market value because that seller has a specific issue. In this case, the fear of an investor in a stock might be enough to cause some sort of distress, or they fall on hard times and they decide to sell the stock when the fundamentals are otherwise good, and you get this sort of fire sale going. So same sort of fundamentals. That's all I'm trying to get at there with this comparison to real estate. That's really what value investing is. You're trying to buy something below market value because stocks are businesses and businesses have value. But anyways, I should actually get into the portfolio now. I made one major adjustment. It's kind of minor in the grand scheme of things, since we're up to almost 50,000. Let's go back here. We're up to almost 50,000 in the portfolio. Granted, I have $3,000 in cash, and I'm not really sure where I'm going to put that quite yet, but I'm going to leave it there so I can quickly jump on an opportunity. And I have all this money in the mostly gold and silver stocks as well, which I will sell as soon as I see there being a better thing to go for. But I just don't want to have a ton of cash right now, given this ridiculous monetary environment we're in. I want to have some inflation protection. Unfortunately, that has not worked in the medium term. I've invested a lot of this money over the last probably 8 months maybe a little bit more than that, well, almost the last year. I think I started more heavily investing into gold and silver stocks in something around July or August of last year. So yeah, about that long ago is when I was investing pretty heavily into this, and I have been adding a little bit to these positions since then. Obviously, copper's done great. Uranium has done well. This is a smaller position, but gold and silver I've not done quite as well as what I probably would have expected given all the printing. I don't know how much Bitcoin is to blame for that, with the same sorts of people who might have gone for gold instead are going for Bitcoin as a fiat hedge. I don't know. Hard to say. I'm going to hold on to this anyways as a cash alternative. In my humble opinion, that is what I'm doing. Doesn't mean that it's good for you or would be good for anyone. It totally depends on your risk tolerance. Since there's a lot of risk caked into here with these miner stocks, for example, this is not just investing in gold. This is investing in miners who are going for gold. So that is one section of my portfolio that I'm using as a hedge to inflation while I look for other opportunities. This is just an index fund of those miners. But back to the value side of the portfolio, I added this new holding with Dropbox. For those of you who are longtime supporters of the channel, you'll know that I recently had Investing with Frank on the channel to do a pretty in-depth breakdown of Dropbox. And Dropbox is a cloud storage company at its core that has other businesses as well, but that's the main one. And it's really in the name. The main product, Dropbox, is just a cloud storage system. You can organize your files in the cloud, and then you don't need to have it actually on your hard drive or whatever on your laptop or PC. It is stored in the cloud, so you get tons of new space, and you can collaborate with your team if you have a business or something like that. It's a handy tool. I've used it before in the past for a couple jobs actually, and probably will if I ever end up hiring people for this YouTube channel. Probably be looking at Dropbox pretty closely as an option, but there are plenty of competitors in this space. I'll get into that in a second, but just want to go over why I even decided to think about opening this in the first place. And Dropbox has a pretty strong cash flow position. So if we look here on macro trends, they have a lot of good stuff on just company metrics, particularly cash flow. So free cash flow is the lifeblood of any business. This is the money that can pretty much go anywhere. This is what can be distributed as dividends. This is what can be reinvested in the business to create new things. This is the good stuff. You want as much of this as possible as a business. So if we look down here, you could see that Dropbox's cash flow position year to year has continued to grow pretty steadily. And that's a great thing to see. They have a nice rolling growth rate, and you can see that they almost eclipsed $500 million in annual earnings in 2020, that being their best year cash flow wise, which makes sense seeing as though there was a lot of people who definitely needed cloud storage, especially if they were collaborating from home. They weren't actually coming into the office, but many offices, it's not like this is just a stay-at-home stock. This is something that offices have been using well before the actual stay-at-home movement that we saw really accelerate in 2020. So this cash flow already has me interested, since when you think tech stocks nowadays, you think very unprofitable, massive valuations with humongous projections for growth in the future. But Dropbox is already quite profitable, which is fantastic to start with. But just because a company's profitable does not mean it is undervalued or even fairly valued and should be invested in. It totally depends on a lot of other things, like the price of the stock. Heading on over to Yahoo Finance, which has plenty of basic metrics on pretty much every stock. Dropbox is trading at about $26 right now, and after hours, that's this number right here, which means its market cap is around $10.8 billion. So still pretty expensive given that the actual annual cash flow is only $500 million. Of course, that's a lot of money, but still not too unreasonable, I have to say, given this environment we're in with tech stocks, since many tech stocks are trading way over that multiple on their free cash flow, way over that. So that seems pretty promising, right? Let's keep looking, and we can see that if we look at their balance sheet, they have about $1.1 billion in cash and about $1.1 billion in debt. So pretty neutral there, not highly indebted. They have cash that could be used to pay off their debt in a blink of an eye if they wanted to, but they don't have to. They have some options there to fund more growth, more research. This is also something you want to do when you look at a company. What's their balance sheet look like? Do they have a massive amount of debt? Do they have a ton of cash? Is there some added value there? If you're buying a company that has maybe a ton of cash and it's not really being reflected in the share price, that is a way to reduce your risk in a way, since the company has more flexibility there. But if they have a ton of debt and not a lot of cash, then that's an added risk, and you need to discount that to whatever you see fit. Here's that video with Investing with Frank, and here's his conclusion on Dropbox that he gave on the channel. I'll include a link to that video in the description below and up top as well if you want to check that out. But here's a snippet of what Frank had to say about it in his breakdown.
So when we're thinking about some of these growth numbers, we have to remember that's been offset by dilution. So if they do compound their free cash flow at 20%, like we talked about, if dilution is occurring at about 3% or something like that, that seems very possible, then we're only looking at a 17% free cash flow growth number. So that's where the downfall in this investment is. If management stop diluting shares so much, it immediately becomes super appealing, in my opinion. Now that's all for my write-up. If you want to go read that, feel free. It is just a very brief summary.
So you can see what Frank said there. He was talking about free cash flow growth at around 17% after you discount the share dilution that Dropbox's team has been doing. This is a risk with Dropbox. They've been issuing new shares, which potentially means that they think that their stock is overvalued in a way, or it's lucrative enough to where they are issuing new shares to bring in more cash for the company to fund new projects rather than do debt, which is a little bit strange in this super low interest rate environment. You'd expect a company that wants to expand to just take out 3% interest debt if they have a strong cash flow position like Dropbox does. So a little concerning there. I don't know how much they're going to be doing that, but of course it could just be that founders themselves are wanting to cash out on a personal basis, since reaching a $10 billion valuation, especially if you were there from the start, that's pretty magical. So they're taking some of that money off the table perhaps by issuing new shares. That is another possibility that's driving a lot of this dilution, but that is something to keep in mind. So let's go on over to a discounted cash flow analysis. This is where you take that free cash flow number and project over the future a growth rate for that cash flow, and then discount it to whatever your preferred return is. So that's this discount rate right here. So I did 11% for this. You can do whatever you want. And what this discount rate really means is that if Dropbox hits all these projections and everything follows this model exactly, then you should be netting an 11% return, assuming you can get it at this price. So that's what a discount rate is. But of course, we're trying to predict the future here, which has some sort of uncertainty, and it's never going to be perfectly correct. That's never going to happen. But you're trying to play probabilities. How probable is this growth trajectory? What is this price at? Is this price super cheap relative to what I think the company will do? Is it a very attractive offer in that way? Very similar to a real estate deal. You're looking at what the company is throwing off in cash now, projecting what the property or company would throw off in cash in the future, and make a reasonable assumption there. You're not going to guess that the cash flow is going to double every single year for a property. Maybe with certain companies it can happen, but I'm just talking about this real estate example. But that's kind of what you're doing in this example. So if we look at the terminal value, this is the multiple of the cash flow. I went ahead and did 15, which might be a little bit on the high side in a reasonable market, but you're seeing a lot of multiples way over that, and really in the infinite range for the unprofitable companies that are worth many billions of dollars right now. But so I did 15 for this. If it's a quote unquote cheaper company, you might have something closer to a 10 multiple, but I did 15 since I think 10 years from now, Dropbox will potentially be a very strong company with still more room for growth. But I don't see the 15 multiple on free cash flow as being unreasonable at all. Maybe a little bit on the high side, but maybe that just means they'll have a little bit more room for growth at the end of 10 years. But again, a lot could happen in 10 years. And I assumed a 15% growth rate over the next 5 years. In the video with Frank, he was suggesting that management was aiming for that 17% rate when you factor in some more dilution with the shares. But if they stop dilution and continue their growth, it might be closer to 20%. So a little bit more conservative. I did 15%. That is still pretty significant after all, though. 15% free cash flow growth for 5 years. That takes a good company to do. So that's what we're starting with there, 15% growth rate, and then it slows down, we'll say, to 5% over the next 5 years. But as the further you get out, because of this discount rate, that compounds as well. This growth rate does not make nearly as much of an impact as the first 5 years because of just the way the time value of money works. And then we saw the $500 million in free cash flow from last year, so I put that here. And then excess cash, that would be any excess cash in the balance sheet. Here I did the cash minus the debt, which ends up being zero. As we saw, they have the same amount of debt and cash, so nothing there. So they're not helping themselves out there for this valuation. When we plug all that in, you see all the cash flows and then discounted here in the PV, the present value of those cash flows. And you end up with this present value of future cash flows when you add up all of this all this column G here, and that's 10.52 billion is the present value of future cash flows. And then you would add any excess capital here to this intrinsic value, but there's nothing to add. So the intrinsic value, according to this very simple discounted cash flow analysis, is about $10.52 billion. Oh, and by the way, this spreadsheet is actually one I ripped off of Investing with Tom's YouTube channel. He has a couple great videos going over how to do a discounted cash flow analysis on a company, and that's what this spreadsheet is from. I'll go ahead and include a link to that in the description below. Go ahead and check out Tom's channel if you haven't already. He has a lot of great stuff on value investing. But anyways, if we compare this $10.52 billion intrinsic value of Dropbox to the current market cap of about $10.87 billion, it looks like it's about fairly valued if it's to hit these projections with an 11% discount rate. So that means that there's not really a margin of safety with this analysis, but it's fairly valued potentially. It seems to have a decent runway for growth. And if we bump this up to say 20%, if they have a really stellar 5 years, then you have a margin there. Or if you lower the discount rate, maybe you only want an 8% return, then wow, that looks like a really nice investment now if they're able to hit those projections. So you can kind of tinker with this. It totally depends on your risk tolerance and also what you think Dropbox is going to do. Maybe they don't grow. And if they don't grow, well, shucks, that's a really bad investment now. You can see that just tinkering with a couple factors can really throw off your projections in a big way. That's why it's important to have a margin of safety when you can get one, and that means you're getting it at a relatively great price compared to what you think it's going to do in the future. In this case, I'm getting it at a fair price, not super overpriced, but definitely not super lucrative. And if it does this, then I would expect about an 11% return. An 11% return is nice. I would definitely take that any day if that could be guaranteed. Of course, nothing's guaranteed, but it's a starting point. So I opened up a very small position in it. And this is my way of making sure that I pay very close attention to this stock in the future. If it has a significant downfall one day, then I could jump in and make a big purchase according to my price target. So if it falls maybe to that $20 range, then it looks like a really nice option for my portfolio. But it might be different for you, of course. Again, not financial advice. Please don't sue me when you lose money investing in stocks. But seeing as though, according to my estimations, it seemed fairly valued, I went ahead and put the $1,000 there rather than leave it in cash where it would be making absolutely nothing. At least there's a chance of it making a decent amount in the short to medium term. That's not really what I'm going for. I want this to be a long-term investment, but seemed worth at least opening the position. And now I am very much incentivized to pay close attention to it. And I don't really have an option since it's right smack dab in the middle of the portfolio, right there in this value slice of the portfolio, which, by the way, you can copy this portfolio if you want to, maybe as a start to your own, because M1 Finance allows you to share this pie, for example. I'll always include a link to that in the description below, and that'll be to the pie of that particular video. So they don't update in real time. It creates a snapshot that you can then edit yourself if you want to, because don't take this as recommendations or anything like that. Not financial advice. I'm going to keep saying that. But if you want to use it as a starting point, maybe like a portion of this, then you can go ahead and do it. And you can also see what my actual holdings are in every single month. Since I don't go through every single holding one by one, I try to focus on the more interesting things that happened in that particular month. But anyways, if you like this video, please like it, since that would help the channel out a lot. And if you like this sort of content about this M1 Finance portfolio, if you want to keep up with the new updates that I'll be putting out every single month, then be sure to subscribe, since I put out other videos as well on investing content as they relate to value investing. Got a lot of real estate content, like I mentioned. So definitely subscribe if you don't want to miss out on that. And if you're more interested in M1 Finance, the platform, then be sure to check out my links in the description below. I include my tutorial series that I have on M1 Finance, as well as a link to actually sign up. That's an affiliate link, and that would help me out a lot. But of course, it's a free brokerage, so there's no risk to you to at least check it out. So I'd encourage you to do that. Oh, and be sure to check out Punch Card Investing. It's a new channel that I'm a part of. It's a live stream we're going to be trying to do every single week, all about value investing. It'll be a great chance for you to ask questions to myself, as well as my co-host, Investing with Tom, Investing with Frank, Karan Gurnani, and Brad Kellner, the stock compounder. So be sure to check out that channel. We're really excited to launch that tomorrow. So about almost 24 hours from the posting of this video, we'll be doing that. So be sure to check that out. And of course, if you can't make it live, check out the recordings as well. I'll include a link to that channel in the description below. But until next time, take care.